Class is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to the November 1st edition of Digging into the BI, where the members from the Maryland and DC regional chapter of Better Investing look at stocks that are in the latest issue of the Better Investing magazine or from their website. And if you're with us now, this is 1 year since we started it. So we have happy birthday to all of us that we've hung on long enough to make it a year. With this being our 13th presentation, we will now have done 52 presentations, 18 different presenters, I think 7 different clubs across the two chapters. So congratulations to that. And I see in the audience, we have several people that have made presentations in the past. So thank you very much for all your help with it. So here are the stocks we're going to be looking at. And rather than looking at that, let's just go to the next slide and take care of some of the household stuff. All right, this is a disclaimer. We are doing this for educational purposes. None of us are investment advisors. We all Better Investing, and those of us that are chapter directors are always encouraging you to do your own research and to figure things out. And then down at the bottom, if you see the stuff that's highlighted in blue, that this session is being recorded for future use, we have finally opened up a YouTube page to store this stuff, and you'll be able to find it at the end of the slides. And we'll talk about that when we get there, but they are recorded so you can take a look at it. Let's go to the next slide. So, who is Better Investing? It's us. It's an investment education organization. And if you click on that link, you'll go to the appropriate spot on Better Investing. And we focus on long-term fundamental investing. And all of us, like I said before, are volunteers, whether we're directors or just members of clubs. None of us are experts in this area other than the fact that we enjoy doing this stuff. Anyway, that's it. Next slide, please. So again, for people that may have a little bit of trouble or new to GoToWebinar, this is sort of what the template looks like. The image over on the right-hand side, that's called your control bar. And you can move that by clicking the arrow, either opening or closing it. You can, if it gets in the way of your viewing things, you can grab it where I have the green circles, and you can move that to the other side or up on top or on the bottom, just so that it's out of your way so you can take a look at it. Your microphone is muted, although we will unmute during question time. Go ahead and raise your hand if you during question time, or you can type in questions in the question box. And to make it easier to type out, you can hit that pull-out button, which is that purple box that I'm pointing, and just determine whether you want to send it privately or you want to send it to everyone that's out there. Next slide, please. So here's some more information. We also get questions about how I can't hear. Since everyone else can hear each other, it could be something that's on your end. And the way to be able to find out is you can look at the help, which sort of looks like that globe button, or you can be able to check your audio settings to see if you're on computer audio or your phone. And then right above it is that sound check. You can click on that to see how your sound is going and the like. The other thing is that to make sure where the green button is to be able to download the handouts. We're having trouble uploading the completed SSGs, but the slide deck is there in PDF form. So go ahead and do that. And if you want the completed SSGs, all of our emails are at the end of this presentation, and you can reach out to any of us, and we will ship out the completed SSGs. Next slide, please. Also, to be able to help you with viewing, you can be able to click on where it says Zoom in the green, in the red box that I have in the middle of it. That can make it bigger if you're having trouble. If we go through something pretty fast, you can always click on the screenshot and be able to capture what's on your screen at that particular time. Hopefully that will help. Next slide, please. So why are we doing this webinar? Well, we want to be able to promote Better Investing and the resources that we have. And if you're not a member of Better Investing, you're still welcome. Just click on that link there and you can get a free 90-day trial. to use our resources and see if it works. We are doing this webinar to help out beginners, people that are uncertain of their judgments, or just people who want to know more about what's going on and be connected with people in the Mid-Atlantic area. We're trying to do best practices. And again, this is a joint program from both the Maryland chapter and the DC regional chapter. And between those two chapters, we have 3 model clubs. And you will see more about that on an upcoming slide. Next slide, please. So in just over an hour, we're going to do 4 stocks. One will be the monthly stock to study from the magazine. You have to be a member to get that. And then the undervalued feature. And then the other 2 will come from either the website or magazine. Any of those things down there, a first cut, a screening tool, a heat map, ticker talk, wherever they can find it, as long as it's something that comes from one of the BI sources is what we're going to use. Next slide, please. So you can always find out what's going on in advance if you sit there and you go to where I have in the yellow highlight on the BI website. You can be able to click on that. It will bring you over to the left-hand side that's in green. It says About Us. Or you can scroll all the way down and go to About Us. And with magic, we'll go to the next slide. And this is what you'll see, is that it's the About Us news release, and you can see that they already announced about 6 weeks or so ago the stock to study for this month, which is Medtronic, we'll talk about, and the undervalued feature, which is DR Horton. And you can already see what the stuff is for December. It's Apple and Citigroup, and we'll talk about that at the end of the show. Next slide, please. So to make sure that you don't miss out on any of these announcements, if you're a member of BI, go to the My Account in the upper right hand, click on that, and make sure to be able to sit there and sign up for email and product subscription information, which is the other red circle over in the lower left-hand side. Next slide. And this is what you'll see. And you can be able to sit there, and if you click where that red arrow is, that has local chapter news and events, if you click on that, but before you, that will get you the local news from either the Maryland or DC chapter, depending on which chapter that you're a part of. And then before you hit that Save Changes, red circle, go on up and see where we have it highlighted in yellow. That's a BI weekly newsletter. And let's go to the next slide and we'll talk about that. This is it. It's a member exclusive thing, but it's a great way to be able to find out what's going on in terms of education from headquarters. So we have things like Ticker Talk, Stock Up, First Cut reports, Stock Ideas. It comes out around the close of business on Thursday. And if you signed up and you're not getting this email, check your spam filter. It's probably there. As you can see with this stuff, they're going to be able to start. We're getting to the end of the year, so there's going to be some club treasurer workshops. So that's a good thing for your club treasurer, the people that are part of your audit committee, if you're in an investment club, to take a look at. Next slide, please. You can also reach out to either of the 2 chapters. We both have Facebook pages, and there's the links to each of them. We don't put a lot of content up there, but there is content there. And that way you can share that with non-BI members if you're trying to be able to show them about your club and what goes on in our community. Next slide, and I think it's to you, Cheryl. Are you muted?
I was. Now I've unmuted. Yes, every month, except for the month of December, the DC Regional Chapter puts on Money Matters book discussion. It's going to now be the 3rd Tuesday of the month. It has switched over. And so people who have been on there before, just be aware that it switched over to the 3rd Tuesday. So the next one is November 16th. Is from 7:30 to 9 in the evening, and the next description of the book that they're doing is the how I invest my money. Financial experts reveal how they save, spend, and invest. And that's by Joshua Brown and Brian Portnoy. And back over to you.
Anna, why don't you tell us about what's going on in the Maryland chapter?
Will do. Thank you. Well, the Maryland chapter, we've got a couple of things that we'd like to point out today, and that is we will have another stock pickers contest that for 2022, which will start in January and run through August. You'll get additional information on that in December, as well as our newsletter, which is coming out at the end of this month. So look for that. And we're also doing a fabulous presentation on the top 100 from the BI magazine. It's interesting to see how we do and do not follow our own practice. So it's good to see if you have the chance to check it out. So check out our website and our newsletter. Thank you.
Thank you. I know I'll be there. Let's go to the next slide. And Jonathan, tell us about your club.
The Maryland Model Investment Club meets the second Saturday of the month. We're still virtual. Our next meeting will be November 13th, and our education session will be on when to sell, and the stock study will again be Addus HomeCare Corp.
And that link that's on there will take you straight to the Maryland Model Investment Club. So you can just click on that right away. Let's go to the next club that we're going to talk about. And that will be mine. And I see some of my fellow club members are in the audience tonight, but this is MCMC. We generally meet at the Rockville Library, but just like Jonathan said with the Maryland Model Investment Club, the Montgomery County, we're meeting virtually. That link is different, but it is the link for us. And we're going to be looking at management for education, and we're going to have a stock study on ubiquity. And if you have any other additional information or concerns, reach out to Ken Williams at that email address. Next slide, please.
And it's back over to me. Starting in 2008, the DC Regional Chapter set up its first Model Investment Club of Northern Virginia that now meets, and that's a new date also, the second Tuesday of the month, November 9th. We are going to be trying something new. All our other activities, including the book discussion, are still going to be virtual, but we have been invited by the Tyson's Pimment Library to come back there. And so we're going to try that out and see how that works on November the 9th. But we're still also going to have a GoToMeeting link. So if you can't meet to come to the library in person, you can still go through the link and join our meeting that way. We're going to education. We're going to be looking at basics of using stock price charts, and the stock study has yet to be decided. And you can contact me if you have any questions about attending the club. Also, we have a visit a club. If you have a club out there and you are looking for people to join, you can come and submit. There's a few papers to submit, paperwork, and then you will be listed as a club that is interested in looking for new members. We have that for both the DC Regional and the Maryland chapter has their page as well that shows up where it talks about chapters. But you can go ahead and click on either under the Maryland chapter or the DC Regional that visit a club link. Also, if you are interested in having directors come and visit your club and help you out with whatever you are interested in, or even maybe a tour of the website, please contact myself, Cheryl Patterson, or you can also contact Anna McBain, who is the lead on the Maryland chapter. And we will see about sending a director either in person if possible or virtually, which is definitely possible, and meet with your club on their meeting day.
Thank you. Okay. So here we have, again, since this is digging into the BI, this is the latest issue. I haven't received my BI in the mail yet, but you don't have to wait for the post office. You can be able to get this. It comes out anywhere from 10 days to 2 weeks in advance. and you can be able to see it on a laptop or a computer, a tablet, smartphone, any of your electronic devices. And let's go to the next slide. And this is how you can be able to find this on the website. If you go to Learning Center BI Magazine, and if you sit there and if you want to get it on a mobile device, go to that link that I have the arrow pointing in green. You can do that. And then the other thing is that with all of this featured stocks, whether it's the undervalued or the stock to study, there's additional reports that are not in the magazine that you can still find, and you'll find them by clicking on that red arrow where you have the analyst reports and other resources. But generally, the mobile device stuff, I get a ping on my app when the new magazine pops in there. And so do that if you want to be ahead of the game. Next slide, please. And so here's one that I thought was kind of interesting from this month's magazine. It's talking about don't fall for value traps. And the author in this one in particular, Sam Levine, is both a charter financial analyst and a charter market technician. There are very few that are actually have both designations. That's both fundamental and technical advanced training. But again, it's like, our biggest concern in the better investing community is getting those falling knives. They look really good, and then all of a sudden everything drops on it. So go ahead and take a look at this article. I think you'll find it well written and of interest. Let's go to the next slide. So here are the two stocks we're going to look at first. We're going to first do the undervalued feature and then the stock to study. We're going to do them in core. And why don't we go to the first one? And Cheryl, you get us started.
Hi, this is Cheryl Patterson again with the DC Regional Chapter, and looking at DR Horton, which is a home builder. The ticker is DHI. Was into the undervalued stock in this month's magazine, but it's also on several predefined screens. So you can look that up in the website. DR Horton is the largest home builder by the number of homes finished and sold under 4 different brands that represent different price points, square footage, and amenities. Also included are some recent acquisitions, including financial services that offer mortgages, title search, title insurance, and homeowners insurance. Here's some data on homes sold. Whoops, sorry about that. Next slide. Here is the SSG, rather the DH Horton from the magazine. First of all, DR Horton is doing so well because of the shortfall in new home construction. And particularly during COVID, the people that live in apartments or in the city have tried to get out of the city because obviously there's a little bit more going on with COVID in the larger cities to begin with. And this gave corporations like DR Horton the ability to raise prices, bolster its order backlog, and strengthen an already solid balance sheet. Some analysts have forecast the company will continue to experience strong results for another 2 years or more, especially if mortgage interest rates remain low. And other businesses include mortgage and title insurance services, and the company recently was providing the mortgage financing for about 58% of the homes that it sold. Now, DHI also can see here the growth, consolidation, and market share that they are on an upward trend here, that beginning when they first started back in 1992, they only had 1,200 closings. By 2006, they had 53,000 closings. They went down a little bit, obviously during, especially during the housing bubble in 2008, but still managed to do quite well. And now, if you look where they are in 2020, they're up to 71,000, and in 2021, they're already up to 89,000 closings. So they have done very well during this period of time. Here's a market share dominance. Looking at the top 5 markets DHI is in the dark blue, and next ranking competitor market share is in the gray. And as you can see, they have done, these are the different city markets. In Houston, they've done much better, Atlanta, as well as Austin. Phoenix, the nearest competition, is a little bit ahead of them, but not by much. Also looking at the top 50 markets, the number one market is they're got over 15% of that. In the top 5 markets, they've got over 35%. And in the top 10 markets, they've got 41%. So they are doing quite well in the competition. Here's a family of brands, the different types of brands that they have out there. They include homes for entry level, which is usually in the first and some in the second category. They've got what they call move up, so people who are selling their homes maybe and moving up for the first time, and active adults, that usually occurs in the second and third categories, and luxury buyers usually in the last category. The majority of homes sold are in the $250,000 to $350,000 price point. But the nice thing about this is you can also see what states that they're happening in as well. And as I mentioned off of one of the slides before, they are in quite a number of the states. The nice thing going for our Horton is they have executives and people at the top of the different branches that have been with the company for quite some time. The executive team and the region presidents have been with them for about 27 years. Division presidents about 15 years, and city managers about 10 years. So that's a lot of experience behind each of the positions and in the total organization. This is showing return on equity, and ROE has improved to almost 30%, while leverage has decreased to below 20%. And we're going to talk about leverage in the next upcoming slides. But the companies that are either in the high teens and then moving into the 20s, and as you can see, they're almost at 30% for the trailing 12 months, are excellent companies that we like the ROE to be in those percentages, moving up in the 20%. Gross revenue of leading home builders in the United States. This was done in 2018. Now, the only home builders that are ahead of D.R. Horton is Lennar Corporation, and they are responsible for about 3 million more closings than D.R. Horton has had up to that point. But the rest of the home builders are nowhere near what they're doing in D.R. Horton. And here's some specifics geographically. You can see that inventory, which is very important for home builders, their inventory mainly is in the southeast, south central, and western parts of the United States, and that counts for about 75%. And you can see the different cities in those different categories in the different states. Also, their home building revenue is pretty comparable to what their numbers are for their inventory. So they aren't far behind actually having the inventory and then selling it and adding that amount to their revenue. Here we see the cash flow. They were kind of not getting ahead in their cash flow as of 2016 and 2017. But as you can see, they have taken off in 2018 to the present. And so having that amount of cash flow has enabled them to do some acquisitions, and we'll talk about their largest acquisition. But it's also enabled them to do a lot with buying up larger tracts of land and also staying ahead of the higher costs of building products. And here's some of the operational focus that the, DR Horton uses. They try to maximize the returns by managing the inventories, the sales pace, and the pricing in each. Consolidate the market share while generating strong profits and operating cash flow. They're maintaining sufficient inventories of land, lots, and homes to support growth plans. They have investment underwriting expectations for each new community. There's a minimum
Please be patient. We'll get this stuff worked out in just a moment. And when Cheryl's ready, she can start up again.
problem there. Yep, I'm back. All right, so back to here. Minimum of 20% annual pre-tax returns on inventory, initial cash investment, return within 24 months or less, and that is very big for home builders, for them to be able to get that investment back in a short amount of time. And we're going to talk about 4-star in a later slide here.
So Cheryl, you have about three minutes left. Sorry.
All right, thank you. 4-star owns DHI owns 64% of 4-star. It's a publicly traded residential lot manufacturer with operations in 55 markets in 22 states. Basically what happens is they are in control of the land and the contracts. They assume the debt for that land, do a little bit of making the land fit for building, like clear cutting and grading, and they assume the debt for the land, which makes Horton able to buy up large tracts of land and keep their reputation as the largest home builder. Here's some CFRA showing it as a 4-star buy, and Morningstar is a 3-star buy. They, like all home builders, they've been hit with the tight construction labor market and building shortages for materials, but DH Horton has still been able to, because of their capital intensity and cash flows, been able to keep going with building more homes. This is value line. Excuse me?
2 minutes.
Thank you. The PE ratio and value line is showing as an 8, whereas the average in the future is a 9.5, so they are undervalued with a timeliness of 2. Here we have historical sales. DH Horton has been able to do a decent number. They haven't, as it said before, they're below Lenore as well as LGI Homes, but they're still keeping pace. It shows on the quarter, and they also are keeping pace. Here's the earnings per share. They have been able to mainstay definitely for the annual rates average. But if you look also in the quarterly numbers, they're doing well as well. Here's pre-tax profit on sales. And here's where they have been doing exceptional, but keeping up with what's going on with the competition. Return on equity. Return on equity, they are also doing very well in the last 5 years average. Here's capital is where they are doing the best. They are managing to keep their debt quite low, especially for a home builder. They're almost half of what the others are. Here's our potential compound total return. It's going to be 21.5% with a 0.9 current yield on, and the 89.3 is the current price. And as you can see, they're definitely in the buy zone. My conclusion is they're a large size, steady growth company. They're a well-managed company. They're definitely showing as undervalued in several places, with trading under its projected 5-year average PE. DHI is a buy up to $109.10 when you look at 3-to-1 upside downside and a 15% total return. So it could be a candidate to purchase, but it also would look good on a watch list.
Thank you, Cheryl. Anna, tell us all about Medtronic.
Hi. Medtronic was featured in the November issue of Better Investing magazine as a stock to study on pages 23 and 24. Next slide, please. The page 24 notes that this is a large company with 30 billion in sales, and Medtronic, I'm sorry, did I say next slide, please? I'm sorry. Hit the 30 billion in sales, and it had an 8 million mark in the first quarter of 2021, which is a change of 22.7% from 2020, the first quarter of 2020. Medtronic's closed on October 29th at $119.86. Do believe that the sales will continue to increase because of delay in selective services from COVID, which now will be executed. And a lot of the elective surgeries that we didn't have in the past from our lack of exercise and eating too much will be allowed. Next slide, please. So with Medtronic is focusing on research and development, acquisitions, and they also have future inventions. Next slide, please. Medtronic is in the medical device industry and the healthcare sector. Is one of the largest medical device companies that develops and manufactures therapeutic medical devices for chronic illnesses. Its portfolio includes pacemakers, defibrillations, heart stands, and insulin pumps, as well as many other medical devices. The company was established in 1949 when two brothers were in the business of repairing medical equipment. Next slide, please. Next slide, please. Next slide, please. When two brothers were in the business of repairing medical equipment, and then in 1957, they started developing and manufacturing medical equipment with the development of the first external battery-powered pacemaker, and the company went public in 1977. Medtronic acquired Covinden in 2015, which is based in Ireland. Being in Ireland allowed Medtronic to move the headquarters there, which gave them a lower tax base. They continued to make acquisitions in 2018. They purchased Maison Robotics, and in 2020, they had 7 additional acquisitions, all of which they paid in billions of dollars for. Their most recent acquisition was in August of 2021. Is an apparatus to treat patients after they've had sinus surgeries to help them get through that recovery process. They currently have in approval a launch for a renal system which categorizes nerves in the kidney to treat hypertension, and that should be released in 2023. Medtronic's executive staff, starting from the scientific medical officer, came from Harvard Medical School to join Medtronic in 2005. Their chief quality officer came from Boston Scientific in 2008. Their current chief financial officer and chairman, Godfrey Martha, came to Medtronic in 2011 from GE's Healthcare and Capital Group. So they've got a strong company executive base for their mission, which is to improve human welfare by alleviating pain, restoring health, and extending life. Next slide, please. The forecast for the high price that I use for the historical high price, I use from 2014, the average from 2014 through 2020, because the last 5 years gave us an average of 33.6. And although I believe that the company is going to continue to grow, I think that the current of 49.7 will not continue to grow at that rate. So I think averaging it out, I came up with the high PE of 35, which gave me a high price stock of 135. Although Medtronic's PE has been consistently high, Medtronic's PE has been consistently high, as you know, the industry and the peers have fluctuated. And as you can see, the peers, the industry has been going down, and the peers are going up slowly, but still. Next slide, please. To forecast the earnings per share, I use the trend instead of the quarterly projections. The chart shows, again, that Medtronic is consistent with their earnings per share, whereas the industry and the peers fluctuated some greatly in the industry, but the industry is rising, and the peer group seems to be leveling out in the opposite direction. Oh God, I had so much out. Next slide, please. Again, with the sales, I use the trend instead of the quarter to show that Medtron's drop in 2019, as opposed to the industry and the peer group, both were rising. The effect for COVID on hit Medtronic a lot harder than industry and their peers. They also had contended with the lack of elective surgeries, as well as the many acquisitions that they made from 2015 straight through to 2021, in which, in fact, they made a large purchase again from 2015 and in 2018. So that all those taking into consideration affected the drop in 2019, but as you can see, they're back on track in moving forward, rising. I think that they've also adjusted their process in the elective surgeries, which is increasing their sales, as well as putting some patents out on the market. They've also, during the pandemic, released their patent for the ventilator machines, so more ventilators could be made by even their competitors, so that there will be more ventilators in the market or available for use in the various hospitals. Next slide, please.
5 minutes.
Medtronic's management, I do believe, has strong expertise and focus on providing less invasive surgery products, which would be needed due to our current lifestyles of eating more and moving less, as far as dealing with hypertension and dealing with your kidney apparatuses, as well as relieving pain from your spinal cords, so that we can improve our lifestyles. Although pretty much for the most part, REOs should be between 15 and 20%. Medtronic's is 7.9, rounding to 8. I do believe that they're using their money wisely to do both acquire companies and expand the research and development, which will increase their sales in the future. Their debt to capital of 35% shows that they're confirms that they're using these resources wisely for future use and purchase of additional R&D, research, and future acquisitions. With the forecast high price of $135 and the low price of $97, the present market price of $119.86, view this stock currently as a hold. Next slide, please.
2 minutes, Anna, 2 minutes.
These are just some articles that I read. One thing I do want to just point out is that the chairman is really very focused on with the environment and global warming. So they're making it a point for their operations to do more environmentally friendly operations. So that's a commitment that he made, and he's going forward. And I think with that, and with giving up the panels for the ventilators, made them a lot of goodwill within the industry. Next slide, please. Medtronic is a large size company, mature growth. It's very good managed company. I think it's overpriced. Is a candidate worthy to put on your watch list, but not a buy at this time. Thank you.
Thank you, Anna. Great job. Glad to have you with us. Again, for people that came, we're ready to do the next two, but just a reminder for people who came late, please download the handouts. We don't have the SSGs. We had a little bit of a glitch getting them uploaded there. So if you want any of the completed SSGs at the end of this presentation, there's email addresses for all of us, and any one of us can be able to send those over to you. Thank you. Let's go to our next presentation, and Jonathan, tell us about Addus HomeCare.
Okay. I'm Jonathan Hunt, and I'll present Addus Home. The ticker heat map here. You can find this stock in the SSG Plus software, and also in one of the predefined screens, raw still quality. Next slide. Next slide. Next slide. That's the ticker heat map. Next slide. Okay, so Addus HomeCare is in the healthcare sector. It's a small company, and it provides home care services such as personal care, hospice, and home health care. Next slide. Personal care allows individuals to stay independent. It's designed to allow the individual to remain in their home. And what Addus provides is similar to activities of daily living, such as bathing, grooming, dressing, and meal preparation. Next slide. Hospice care is end-of-life care, and Addus will provide emotional care, palliative care, and bereavement counseling. Next slide. Home health care is care that's planned and designed to be delivered by medical professionals such as nursing, physical therapists, speech therapists, and occupational therapists. Next slide. Now, Addus is also trying to capitalize on healthcare trends, and some of the biggest trends going on right now are the aging population. Medical advancements are allowing people with chronic illnesses and disabilities to live a lot longer. So this population is increasing in size. And there's also a desire to keep people people at home, or at least out of the emergency rooms, hospitals, and nursing homes, where the cost is a lot higher. And you can see the graph, home healthcare market is trending upward almost exponentially. Next slide. Addus is in 210 locations in 22 states, and they serve 44,000 consumers. Now, more than 80% of the revenues are coming from the personal care sector. And then we think of personal care, this is on a long-term continual basis, where the average consumer is being taken care of for at least 26 months. And keep in mind that without this care, consumers generally homes where the cost is about 3 times higher. Next slide. A large majority of Addus's revenues, at least in 2014, came from the state of Illinois. They have done a fantastic job of diversifying their payer mix, and the state of Illinois currently provides about 20% of the revenues, where 80% comes from managed care organizations and state and federal organizations such as Medicare and Medicaid. The bar graph at the bottom will demonstrate the home health expenditures funding. And you can see first, there's 2 things I want to point out. The graph is continuing to increase, and that's great. So payer funding will continue to increase in the future. And the bulk of the payer sources are Medicare and Medicaid, and you can see those by the light blue and sort of the grayish blue squares on the bars. Next slide. Addus has a very strong growth strategy, and this is just a small snippet of their growth strategy. It's pretty extensive on their website. Organic growth is similar to same-store sales, and some of the things I want to point out is, one is they want to increase their alignment with payers, and this is important because if you have one of the payers that's deciding that they want to decrease reimbursement, Addus wants to be in a position where they can at least educate those payers regarding the cost benefits of Addus's services. They want to enhance or continue to grow their sales force and also invest in technology such as telemedicine and artificial intelligence. They have a very strong acquisition program going on right now too. Next slide. The sales and earnings lines look fantastic. In fact, the price bars, the black eye bars, are almost in lockstep with earnings. So they're continuing to increase. I want to focus on that light blue line at the top. This is shares outstanding. And over the last 4 or 5 years, shares outstanding have been increasing, which means Addus is actually introducing more shares and they're selling more shares. And they're doing this to raise capital for their acquisition. Now, it's interesting because Addus has about $150 million in free cash flow. So that's just something, it looks like it's leveling off to a certain extent, at least for the last couple of quarters too. The dotted green, dotted blue lines are my sales and earnings forecasts, and they're spot on with the sales detailed estimates and slightly, well, somewhat below the earnings per share detailed estimates, and we'll talk about my forecast. Next slide. The quarterly trend graph is showing, at least over the last 4 or 5 quarters, there was a downward trend, primarily due to the pandemic. And now, but there's a change in direction, at least for the last quarter. For sales, it's sort of flattening out, but there's sort of an upturn in the direction for earnings and pre-tax profit, also for profit margins too. So things may be turning around for Addus at this point. Next slide. The sales and earnings growth trends on an annual basis look pretty good. They have significantly increased early on to the point when, now remember, this is a small company, and over the last 2 or 3 years, they were achieving sales and earnings growth over 20%, and this is fantastic. However, you can see from the graph that the growth is slowing somewhat. Sales growth, the trailing 12-month continues to trend downward at 10.7%. Although they did have a great quarter, their most recent quarter, they had sales growth of 18.1%. The earnings growth trend looks great. It's actually looks like it's turning upward. The trailing 12-month at 18.5%. And they also had a fantastic quarter of 67.4%. Next slide.
5 minutes, Jonathan, 5 minutes.
I like to compare the target company with the peer group averages and the industry averages. Now, I did select National Healthcare, which is a small company, Motive Care and Aviana Healthcare as which are medium-sized companies. And I selected these as direct peers. So Addus has done extremely well with regard to the peer group averages and the industry averages in just about every growth metric. Now, I highlighted the peer group average under return on equity because when you go and do your analysis, take a look at this. I didn't include this in the presentation, but the peer group average is 16.5%, but they, as a group, they had a 170% spike in their return on equity in 2020. So for whatever reason, I was not able to discover, but I would have to assume that they might have something to do with the pandemic too. But all in all, I don't see any red flags with management. I think management is doing a great job. Next slide. I tabulated the analyst forecast and I put a red star under Addus because they are pretty aggressive at making sure that their sales growth is a minimum of 10% going forward. I use the average 11% for my forecast sales and earnings. And then I use Manifest Investing as my second opinion. And you can see Manifest Investing is suggesting a forecasted sales growth of 14.8%, which means the current sales of 772 million will be about will double in the next 5 years to 1.5 billion. My 5-year estimate of 1,370,000,000 is below that, which is somewhat conservative. My 5-year estimate for earnings is $3.99, also conservative when you compare with Manifest Investing, $6. Now make note of that third one for the average PE ratio and $186.14 for Manifest Investing's future average price. Next slide. So the PE, the current PE is 39.5, and that's higher than the average PE of 35.3. Addus is currently overvalued at this point. Now the big charts just below that, the yellow chart, PE has been trending upward. However, in 2021, circled 2021, and you can see there is a downward trend in the price earnings ratio. And remember, Manifest Investing is also suggest average PE of 31, and Value Line is also suggesting that future PEs are going to decrease to around 25. So I took that into consideration that PEs are probably going to continue to decrease. So instead of using the high and low average PEs, I settled for the average PE of 35.3 to calculate my high price. Next slide.
2 minutes, Jonathan, 2 minutes.
So I'm getting a high price of $140.80, and I used 75 as my low price, which represents 20% below the current price of $93.50. Next slide. So if we were to purchase Addus today at $93.50, we would only be getting returns of 4.6 to 8.5%. However, Addus is, I think it's a phenomenal company. It's got a huge potential for various reasons. The elderly population is continuing to increase. In fact, analysts are anticipating 100 million individuals within this population within the next 40 years in 2060. Payer funding is going to continue to increase. Government support has been great. As devastating as the pandemic has been, it has increased focus on high quality home-based care. There are many health agencies that are going to be ripe for acquisitions, and revenue and earnings growth are really fantastic at this point. Next slide. So Addus is a small company. Its moderate growth is, I think, is very well managed, but it's just overvalued at this point. So I think it's worthy candidate to add to a watch list, and just keep an eye on that price earnings ratio until it comes down to a good valuation for you. Thank you.
Thank you, Jonathan. Very good. Well, I'm up last, and so like Jonathan, I'm going to do this in SSG Plus, and I decided to look at Take-Two Interactive Software. I found them really on the predefined screen, the value screen, but it can also be found on the ticker heat map. Let's go to the next slide. So here's the predefined screen, and if you want to know the metrics, right next to the value is a question mark. And if you do that, you'll pull out where I have the arrow going to the value screen so you can see the criteria. And I was just sort of thumbing through there, taking a look at them. And this is the one that sort of caught my eye, was Take-Two Interactive. So let's go to the next slide. So here it is. They're in the S&P 500. It's a medium sales size. They're in the gaming industry, headquartered in New York, generally known for Grand Theft Auto and NBA 2K. But here's the thing, the gaming market was 155 billion last year, and it's expected to grow to 260 billion US in 2025. And over 40% of Take-Two's sales are international. And as you see from the screen capture down in the lower right, it's listed as a great place to work, both by Fortune and by this other place that I found on their website. Let's go to the next slide. So you can find a lot of stuff at either Morningstar, CFRA, or Value Line. And this one I decided to go to Morningstar. If you go to the Morningstar page at the library and you click on the newsletters that I have highlighted in the orange box, in this month's issue in October, well, it's now November, but in the latest issue of the Stock Investor magazine, they have a feature on Take-Two. It's very similar to what you'd see in there, but it's worth a look. Over on the writing I have on the left-hand side, the things that are underlined in blue, those are all hyperlinks if you need to be able to know what the metrics are for what they mean by a moat or capital allocation. And then the one down at the bottom is there. Basically, moat is a moat. It's a Warren Buffett term to be able to protect your profits by having a moat around them so no one else can get in there. And the fact that they have a exemplary capital allocation is usually an indication of very good management. So there's some really encouraging things here. Next slide. So when you think of gaming, you probably think of that guy over on the right, sort of sitting in the basement with mom upstairs. Maybe the lights are off or something like that. But again, like I told you in the earlier slide, there's 155 billion last year. 65 billion of that is in the U.S. And that it's just continuing to grow. And there's a big movement in terms of stuff going into mobile gaming. So it's not just having to sit in your basement. You can do it off your phone and your tablets and the like. Let's go to the next slide. Really, it's not so much that they're sitting there. It's time for us to rethink gaming. The fact is that gamers are in the prime demographic of 35 to 44, and only 29% of the players are under the age of 18. And here's the thing: the stuff down at the bottom. I have later on a YouTube link there to this presentation. But video games have greater revenue than music and film combined. Think about that. They have more revenue than music and film combined, and they've been doing that for 8 years. To give you another idea of this is that when Tiger Woods won the 2019 Masters, he won $2 million. Well, over that, a couple months later, there was a 16-year-old kid, just a few years older than his own daughter, who ended up winning 50% more, or $3 million, playing a game. So the fact is that there are professionals that can be able to play it at levels equal to professionals in any of the other sports. So there's a lot to think about with this. Let's go to the next slide. And so here's some more. This just sort of shows you some of the stuff that's going on worldwide. Obviously, China is really big with this, as is Russia. But the fact is that, again, the mobile industry is just going to continue to grow. And, you know, there's other countries, Japan, South Korea, India, Russia, Germany, the United Kingdom, and us, Mexico. We're all in there being able to do this. So it's a huge, huge market of things going on. Next slide. So here are some of the articles that I found. One is Investopedia. I like to go there just to see what they have, and they can start to tell you how the video gaming industry. There's 2 Motley Fool articles. And again, if you download this handout, you'll be able to hit these for the hyperlinks. A good Barron's article on it, and then also that down at the bottom is the YouTube presentation. It's by a private venture capital firm, but again, they really do talk about some really interesting things going on in the gaming industry. So if you want to know more, look at those articles. Next slide. So again, Take-Two is the one in the upper right with the orange box, and if you look at that, it's got some wobbly stuff further out. But again, look at the last 5 years from 2016 going forward. That's a classic up, straight, and parallel. Now compare that over on the left-hand side, ATV, that's Activision, and that's in the Better Investing Top 100. And they look like they've struggled a little bit more in these more recent years, and they were much better in the years 2011 to 2015. And then down below, EA is Electronic Arts, and that's in the BI Top 200. And again, they look like they've struggled over the last couple of years. And then the one in the lower right is Zynga, um, and the like. And they really look like they're just starting to start up. But that gives you an idea of some of the competitors in terms of what they're doing. Next slide. So you can go to the research tab and pull down things from either Yahoo Financials, or you can be able to sit there and look at the company's earnings call. I've done both. You can see that the stock equity has doubled in 3 years. The free cash flow has gone up 2.75 times in the last 3 years. They talk about how they're really focusing on their mobile devices as a key growth driver. And they're talking about doing a lot more acquisitions. They're actually in fiscal year 22 right now, and how they've made a couple acquisitions back in June to be able to help either with motion capture or more mobile games and stuff like that. So there's some really interesting things going on with them. Let's go to our next slide. So here's the historic sales growth, and I always like to sort of compare it to the competitors, and you can see how they correspond. Up on top is Activision because that's the largest one. But look at the numbers down below. The peer group average is growing at 5%. Take-Two is growing at 14%. And again, I put all the years in there, but if you just look at from 2016 on, the one that has the straighter, more upward trajectory line is Take-Two on most of these upcoming slides. Whereas some Electronic Arts and Activision are both significantly less than where Take-Two is. Next slide, please. So here's
5 minutes, Kevin.
Thank you. So here's the historic earnings per share growth. And again, Zynga's starting to look a lot weaker. And again, if we looked at the front side, this is not too surprising. But again, there's much more consistency in Take-Two than there are in some of their competitors. And I didn't do any of the outliers. That's the reason the Take-Two number is really, really high. When you take out those earlier years, it's down around 20, I think it's like 20 or 30%. But again, it still has the most consistent straight lines of all of them. But you can't deny that both Activision and Electronic Arts also have good numbers too. Next slide. So here's a pre-tax profit. Again, Zynga is looking really kind of weak. I have that red line there to be able to show you where the zero or anything below that red line means that there's negative profits. Zynga is, again, I think we're going to have to consider dropping them from this consideration. But 11% pre-tax profit from Take-Two is really good. The 5-year average for Electronic Arts is good. They're the one in green. But look at how it's starting to tank down in terms of its rates. Activision Blizzard is clearly the best on the pre-tax profit. But again, there's great movement by Take-Two in terms of a steadily increasing 2A. Next slide. Return on equity. I'm going to drop Zynga with my future slides. We have a strong number from Electronic Arts, but Take-Two is right there in terms of what it's doing. Again, the 5-year average is 14.6% for return on equity. But again, look at how those numbers have gone from 12.5% to 18.5%. And it just seems to be steadily climbing. Let's go to the next slide. Here's debt to capital. And here's the thing is that debt to capital if you have a lot of debt, you can really raise your return on equity. And if you look at that hyperlink I have there that from the Rocky Mountain chapter, they talk about this and the fact that, again, here we want to have lower is better. And again, Take Two has clearly the lowest debt. In fact, quite frankly, all of them are much better than the industry average. So you can give them all credit. But the fact is that the one with the least amount of debt is Take Two, and that would actually show how much stronger their return on equity is. So it's really starting to show up as a good one. And again, it's not to be able to take anything away from Activision or Electronic Arts, but I'm starting to zero in on Take Two. Next slide. So
2
here's
minutes, Kevin. 2 minutes.
Thank you. So here's my forecasting sales. I did 9 and 9, and you can sort of see I plotted out the future stuff either from analyst consensus estimates or from value line to like. And let's see if we go to the next slide, I can show you how I sort of came up with the 9%. I used a preferred procedure. It gave me 7.8, but there's a thing called the implied growth rate. They're not Take Two doesn't pay a dividend. They have very low debt. And so they could very easily grow even much higher than what the analyst consensus say. And so I'm happy just to stay right around 9%. I think that's conservative. I may actually be too conservative. It could very easily be probably 11 or 12% in terms of future earnings growth, and not really impinge on them too much. Next slide. Historic high and lows. If you see that, the PEs are high. And that's a concern. All of these gaming companies tend to carry really high PEs, but again, they also have no payout ratio. But those numbers are coming down, and for us as better investors, we sort of like that and see if we can find something that works. So I'm going to anticipate that in section 4. Next slide. So here are my high and low prices. I took a high PE of 36, a low PE of 24. Gives me a high price of 310 and some change. I selected a low price of 134 using the growth option. It's about 74%. It is 74% off the current price. And I think that's kind of reasonable for where they are. Next slide.
1 minute.
Thank you. So I have it as a hold. It doesn't quite have 100% price appreciation. It's but generally not too bad. Next slide. My 5-year potential, again, there's no payout ratio. It has 11% potential return if we're on the high side, 7.4 on the low side, if we're using the projected average return. And again, I could probably move this earnings number up higher from 9 to maybe 11 or 12, and this could probably even get into the buy range. But I'm being a little bit conservative. Next slide. Ratios are telling me, yeah, they're probably fairly priced. But the PEG ratio there, that's telling me it's a little bit pricier. And if I did raise the future earnings per share, that would come down, but it's still kind of expensive. Next slide. So it's a steady, medium-sized growth company. I think it's well managed. I think it's fully priced. It's trading just below its projected 5-year average or 5-year high PE. If I'm patient, maybe it'll come down a little bit. I think the buy price is at 154. I think today it's like at 182. But it's a good candidate to be put on the watch list and a very interesting company. So that is it. Thank you all. Let's go to our next slide and sort of, there's our recap. We threw 4 companies at you very, very quickly, and we'll have our presenters as we come through. We always like to be able to talk about where it fits in the life cycle. So let's go to the next slide. If we can move on to, there we are. This is sort of a standard that we do is, this is T. Rowe Price talking about how companies tend to go through a growth and maturity and decadence. And we're going to ask our presenters where they think their companies fit in the whole scheme. Let's go to the next slide, please. This is a standard image. You can find it in the SSG digital handbook and the like. It's always been in some of the toolkit stuff as well. But with that, Jonathan, why don't you tell us why you put Addus where it is in terms of in that sort of explosive growth area?
Sure. Now, keep in mind that Addus is a small company, and I showed on the sales and earnings growth trend that they had fantastic growth. We expect sales and earnings to grow at least 12%, and at a few points over the last couple of years, they were growing sales and earnings over 20%. So it's also slowly reaching medium-sized company status. So over the next few years, I would anticipate they're going to be reaching that medium status over $1 billion in sales. So it's going to be naturally occurring that they're going to start slowing down their sales and earnings growth. And we can also see some evidence of that in the trailing 12-month figures that I had presented. So I think it might be beyond the early explosive growth, but I think there's still a lot of runway left for them to grow very, very nicely in the future. So I wanted to put it somewhere around the middle of that explosive growth phase.
Okay, thank you. Cheryl, tell us why you picked that spot for DH Horton.
That's okay. DR Horton, I think they were more in the mature growth area, but they've done some things that have, I think, moved them back into slightly below the line that separates explosive from mature growth. That is making sure that there are homes available in that startup as well as in the ones where people are selling their first homes. And that a lot more people, again, are looking to move out of rental units and move into either their first home or into a better home, a better size home for their family. One of the other things that's happening is there are older people who are downsizing, are moving out of the home that they perhaps raised their family in and looking to move not only into a smaller home, but one that's in a warmer climate. And this is where DR Horton really moves ahead of the rest of the group, is that they are predominantly, as I showed on that map, in the south and southwest areas that are growing expeditiously. So I think that really puts them in a situation, along with that financing group, where they're having a little more explosive growth right now.
Okay. And Anna, tell us why you put Medtronic where the red star is.
I believe that it's a mature company. They have their sales are going slow, and I think it's along the lines with the research and the development. It takes a longer time to get something created and then produced and then approved before it can go to market to sell. So I think that's why their sales are slow and they'll continue, but they'll be slow because they've been around for some time. Mm-hmm. It's a large company, and you expect it to be slow at this time.
Okay. And with Take-Two, well, even though it's in the S&P 500, which is for large caps, it's still a medium-sized company and growing at pretty much a medium-sized company. I think there's a lot of potential growth that's still going on. And like I said, the video gaming industry is more than both the movies and film, movies and music combined, and has been for 8 years. There's a lot of tie-ins that are going on, a lot of creativity that's going there. And again, their primary demographic are not the people under the age of 18. They're over, 70% of their audience are people that are adults, and they're really adults in that prime demographic area of 35 to 44, and they're going to those are ones that are most likely to have the money and resources to want to be able to spend on that. So I think they're well positioned for it there. Okay, let's move on and let's go to our next slide. And I think we're getting pretty close to the end here. Kent, you want to tell us, tell you what, let's hold off on this. I think it's time to have people vote. Let's put up the vote, and then once we come back, Kent, you can take the next 2 slides, okay?
All righty.
So after all of this, go ahead and pick what, it doesn't necessarily have to be the one that's a buy right now, but which one would intrigues you enough that you want to do some of your own further research on. Well, we're voting very good. We're up to 70% of you are voting. Let's see if we can get that up over 80, maybe even 85. Can we get on up a little bit higher? A little bit higher. We're at 83. I'm going to count off 10, 9, 8, 7. No one's moving. Go ahead and close it out. And we'll let everyone see the exciting results there. It's a dead heat. Dead heat between Addus and Take-Two. Okay. Well, that's a very good. Thank you very much for participating in there. We had full 83% of you participating, and we like that. And all. And if we can take that down, and Kent, tell us all about how they can volunteer and be part of either of the two chapters.
Right. Well, actually, first, let's say that if you found the information we shared this evening helpful, if you found it inspiring, please feel free to share that with somebody else. As Kevin mentioned, everybody who participates in this event are volunteers. And as volunteers, we learn new things, and we keep learning new things as we find little snags here and there. And so take a chance, or take a look at some of the things that you can get from volunteering. Learning new skills is very helpful. Getting discounted rates at the Better Investing National Conference is also very helpful. But you can also get good subscriptions, complimentary from BI. But the most important thing really is to learn new skills and help educate other folks so that we can help others retire with funds in their bank, as opposed to, as they say, friends don't let friends retire broke. So get out there and give a hand. Thanks.
Thank you. Let's go to our next slide.
Next.
And again, since you guys have been asking a lot for replays because we go through this kind of fast, we now have a YouTube page. It's under the DC chapter, but make no mistake about it. It is both a Maryland. This thing is a joint product of both the Maryland chapter and the DC chapter. We're going to try to put up more of these as we go through it. And the like. You can just type in digging into BI in the search window in YouTube, or you can just do digging into BI webinar. I tried both of it just in a Google search or any kind of search engine, and I was able to find it. So go ahead and try that. You won't have the handouts. That's one of the reasons you have to sign up and be here. And like we said, if you do want to be able to have the completed SSGs, I will have in 2 more slides email addresses for all of us to reach out to. Let's go to our next slide. So this is just a reminder that, investment education is learned by doing. These are our judgments. These are our opinions. We strongly recommend that you do your own research and come to your own conclusions on each of the stocks that we ended up presenting here. And if you're not a member of BI, please consider joining us. There's a link at the beginning for a free 90-day trial, and you too can become a better investor. And like Kent said, friends don't let friends retire broke. Let's go to the next slide. I think we got 2 more left. So here are email addresses for everyone. Kent's there also for the Maryland Model Investment Club. And you can reach out to any of us for those completed SSGs, or if you want follow up on any of the presentations with the presenter, do that. Next slide. Here's what we're doing next month. We're going to have Apple, which is a stock to study. The undervalued feature is Citigroup. We're going to have one from the heat map, Boston Beer, Sam Adams. Or Sam is the ticker symbol. And then from Ticker Talk, we're going to be looking at the Southern Maryland Bank Corporation. So that is it. We will open things up now for questions and the like. Kent, did we have any questions or any comments that people want to be able to go through? And you can either raise your hand and we'll unmute you, or you can type something in there and we'll try to answer some of your questions. We'll take a couple minutes worth of these.
Let's see. I am not seeing any questions.
Oh, I think I saw one here.
Actually,
Go ahead.
yeah.
Go ahead.
Yeah, I was going to, the one question I was going to ask is what do you think is going to happen with Take-Two given China's restrictions of game playing on young people to 3 hours per week? 1 hour on Friday, 1 hour on Saturday, and 1 hour on Sunday.
Okay.
And
Well,
only between 9 and 10 p.m. So,
that would probably impact someone who's more a Chinese-based company. While Take-Two has 40% of its sales are international. I can't tell you how much of it is actually in China. But again, here's the biggest thing to keep in mind is that 70% of their audience are people over the age of 18. And like I said, they're in that critical demographic of the 30s to 40s, early 40s, to be able to take care of that. But their market is mostly here. And I think that's going to be the same for others. If this was more of a Chinese-based video gaming company like a Tencent, I'd probably be a little bit more concerned. But I don't really worry about it too much because of what I already just said.
okay.
Anyone else want to raise their hand or?
Any other questions? Let me just take a look here.
Yeah, it's
Let's
awful
see.
quiet on questions tonight.
Yeah.
Either we're
I
really,
think we're
really
good.
boring, or maybe we just sort of overwhelmed them with our pure knowledge. I'm going to go with the latter. We just were so phenomenal.
We had good presentation. Yeah, I don't see any questions or hands raised. So
Boy,
yeah.
we may just have to get off here.
All right. I think we're done.
Well, thank you very much. We'll hope to see you next month. Check out the YouTube page for this. We should have it up in, I don't know, maybe a day or so. Give us some time. And thank you very, very much for celebrating 1 year on digging into the BI. Good night, all.
Good night.